Good day and welcome. I understand you have read through the BIE 420 project description, so I can dive directly into the deep side. Okay, for all three options, the share data are calculated on the data calculation sheet. The levies and rates on taxes are calculated here. As you can see, the yearly average is calculated and added to the last levies on taxes, and then it was calculated to a monthly rate and then to a yearly rate. The inflation rate from the past 5 years was used to calculate average inflation rate, and the tax bracket was increased with 4% each year. 2018 we assumed it stayed the same, and 2019 up until 2013. The living expenses was calculated by a website. I can't find it, not quite here. Okay, I find it. The living expenses calculated by NIBO for a single person. You can compute it here yourself. To get back to the data, the value of the house was the growth over the 5 years were determined, and then after 5 years this 5.5% increase per year was used to determine it in year 2013. Then the salary increase was 7% till 2023, and then the before tax mark, which was used, you can see it was calculated here. Assumption of the gray and the yellow are discussed here. Okay, and let's get back. Let's start with option 3. Okay, on this sheet, the data for the tax deductible expenses from selling the house was calculated. These values were got from a real estate agent, the cost of selling a house. So, for example, you're gonna ask for this agent fee, but there's other fees that's going as well, like for cancelling the current contract, the deeds offers, etc. And then the capital gains for selling the house for 920 can be seen here with a profit of 90,000 whatsoever. Sorry for pausing so much. My PowerPoint recorder didn't work, so I had to download another recorder. Okay, so for the financial advisor to invest the remaining money from the house after the bond has been paid off, the bond of 400,000, which is available to invest, is 440,000. So it was invested here at a 10% interest rate. The advisor invested it in a low risk trust, and here you can see the values for the advisor's fee and the unit trust value after 5 years, and then the capital gain that I got from the unit trust can be seen here. It was included in the taxable income. Just note that this might be higher because this might be higher, but this is not in this case. In option 2, it's higher. The trust income was separated from the operating income as seen above to calculate the tax. Now, it was not the total trust income was not added to this formula. As you can see, it's not included, but the capital gain was included in the taxable income. So yeah, you can't tax that. And then the rest of the values, no, it can't be seen here. Let me quickly pause. Okay, I've got my bearings together. So in 2019, the first year, we assumed this sale is going to take 3 months to sell the house. And we give the tenants another month. So at the end of December, from August, they should be out depending on the contract. By the 1st of January 2019, or end of 2018 is the start of all this financial analysis. So the operating income consists on sheet 3 from the income, which we calculated somewhere here, salary. There we go. So included it there, and then the tax deductible expenses was used from the only expense was for tax deductible was advisor service fee, and then living expenses were deducted in order to get the before tax cash flow. So all the taxable income was only from operating minus the tax deductible expenses, and then you can calculate your NPV from the MAR, what was get on the data calculation sheet whatsoever. Okay, let's go on to option 2. Okay, this is option 2. It's almost the same as option 1. Let's start with option 1. It's actually a bit easier. Okay, here's the assumptions. I'm not going to discuss them all as there's not enough time. You can read through them. Okay, so the tax deductible expenses is for like plumbing the house, doing major upgrades. These balance was then used for an extra refinancing fee, and the fee was then added to the remaining bond value. As there's no cash yet, as you have directly paid all those expenses off, you still have no cash at the beginning. But at the end of 2019, you've got an operating income from your cash. Let me see. Yes, from your yearly income from renting out the house as well as your salary. In this case, we said we're gonna refinance the house in 1 year. Okay, so she's gonna refinance the pay off the bond, which escalated with let's say 46,000 interest. The interest calculation can be seen. Let me quickly see. Okay, yeah, the interest is calculated by the remaining bond value and the interest component of 10.2%, the effective yearly interest. We assume she can pay it off in 1 year, as she has a really large salary and can pay the extra fees. Okay, let's go to the second part. The middle part of the table is all the same. Okay, so this is the part I want to discuss. She's still in the tax bracket. As you can see in year 5, she sold the house for 265. Okay, she got an operating income of 265 million, 2.6 million, and in this year, this operating income can't be added to taxable income because you have to calculate the capital gain as I did here. So it is calculated of the yearly income plus the capital gain plus the salary, which is taxable, minus the tax deductible expenses. Okay, the tax deductible expenses for this major year is the maintenance cost, the rental agent fee of 6%, and the tax deductible expense of minus 91,000, which is this value for that. The other tax deductible expenses was just the maintenance cost, as there's no major upgrades, maintenance cost, and the rental agent fee. This is option 2. It is almost exactly the same as option 1, except there's a 50,000 increase in the refinancing fee for finishing the apartment, and there is different commissions that's worked out. The apartment's rented out for 700 Rand a month, and it's an average 12 days a month. Okay, in conclusion, I would recommend option 1, as at the end the growth of property is more stable than the growth of a trust unit. So at the end, this would be a bit better. And if you decide not to sell it and keep the house, you would be definitely better off, as then you still have an asset. You can see it's the NPV is larger for option 1, then in second it's option 2, and then option 3. Thank you.